Margaret wanted to help her daughter, so she signed over a block of stock she'd held for 30 years, about $200,000 worth, straight into her daughter Anna's name. It felt generous, simple, done while she was still here to see it. But Margaret didn't know one rule. The gift was real, and so was the tax bill she just handed her daughter. Around $27,000 Anna would never have owed if Margaret had done nothing at all. Here's the rule almost nobody plans around: the step-up in basis. When you buy an investment, the price you pay is your cost basis. When you sell, you owe tax on the gain, the difference between the sale price and that basis. Now here's what happens at death. When someone inherits an asset, the cost basis resets. It steps up to the asset's value on the date of death. Every dollar of gain that built up during the original owner's lifetime for the heir simply disappears. They could sell the very next day and owe little or nothing. A lifetime of growth, wiped clean, just by being inherited instead of given. This is where Margaret's good intentions cost her. Let's use real numbers, an illustration, but the rule is exactly this. Margaret bought that stock decades ago for $20,000. Today it's worth $200,000. That's $180,000 of built-in gain. When she gives it to Anna while she's alive, the tax code says Anna inherits Margaret's basis too, the original $20,000. It carries over. So when Anna sells at $200,000, she owes tax on the full $180,000 gain. At 15%, that's about $27,000. But if Anna had inherited that same stock when Margaret passed, the basis would step up to $200,000. She sells at $200,000, and the taxable gain is zero. Same stock, same daughter. The only difference was gift versus inherit. $27,000 decided by one rule most people never hear about. So why do people gift early? Almost always for good reasons. They want to help while they're alive. They want to avoid probate. They want the joy of giving with warm hands instead of cold ones. But here's what nobody tells them. The more an asset has grown, the more expensive it is to give away early, and the more valuable it is to simply hold. Generosity and taxes can point in opposite directions. And there's a quieter version of this same mistake, one that millions of families make without ever signing a single gift. To avoid probate, a parent adds their adult child's name to the deed on the house or onto the brokerage account. It seems harmless, it feels organized. But in the eyes of the tax code, adding a co-owner is a partial gift. You've just handed your child a share of that asset, at your basis. And that gifted share doesn't get the full step-up when you die. Only the part still in your name does. So the house you bought for $80,000, the one now worth far more, by putting your child on the deed, you may have quietly traded away half of the step-up they were going to get for free. Plus, that share is now exposed to their creditors, their lawsuits, their divorce. Now let's see how big this gets with a home, because that's where it hurts most. Say Margaret's house was bought decades ago for $80,000. Today it's worth $580,000. That's a $500,000 gain. If Margaret sells it herself, she gets the home sale exclusion, $250,000 of gain, tax-free for a single owner. But the other $250,000 is taxable. At 15%, that's around $37,000. If her children inherit the house instead, the basis steps up to $580,000. They sell, and the taxable gain is zero. The entire $500,000 in growth erased. Now, the nuances, because they change the answer. First, not everything gets the step up. A traditional IRA or a 401k does not. Those are taxed as ordinary income to your heirs no matter what. The step-up only helps taxable assets, like a brokerage account or real estate. Second, where you live matters. In community property states, when the first spouse dies, the entire asset can step up, not just the deceased spouse's half. A surviving spouse can get a double benefit. And third, the step-up is measured at the date of death, though an estate can sometimes use a value 6 months later. Now, one thing people get scared about, and they shouldn't. This has almost nothing to do with the estate tax. For 2026, the federal estate tax exemption is $15 million per person. The overwhelming majority of families will never owe a penny of estate tax. And yes, a large gift means filing a gift tax return. But under that 15 million exemption, no gift tax is actually due. So the cost of Margaret's gift was never gift tax. It was the step-up she threw away. This is about income tax, the capital gains your heirs pay when they sell. You don't need a big estate for it to matter. You just need an asset that's grown. But here's the part people miss. The step-up cuts both ways. Basis resets to the value at death, whether that value is higher or lower. So an asset that has lost money steps down. The loss your heirs could have used? Gone. That flips the strategy. For your winners, holding until death can erase the gain. But for a loser, an investment deep underwater, it's often better to sell it yourself while you're alive, claim the loss, and use it. Don't let a step down quietly waste it. So what should you actually do? A few simple moves. If you want to give while you're alive, give cash or give assets that haven't grown much. Those carry little hidden tax. Keep your most appreciated assets to pass on at death, where the step-up does the work. If you're charitable, give appreciated assets directly to the charity. A charity pays no capital gains at all, and you may still get a deduction. The gain simply vanishes. And if a family member is in a low-income year, remember the 0% capital gains bracket. Sometimes the gain can be realized at no tax at all. So what does this mean for someone like Margaret? If you're holding an investment that's grown a lot and you want it to go to your kids, gifting it during your lifetime can quietly hand them a tax bill. Letting them inherit it can erase that same bill entirely. It feels backwards. We're taught that giving early is the generous move. But with a highly appreciated asset, sometimes the most generous thing you can do is simply hold it and let the step-up do the work. Margaret's heart was in the right place. Her timing wasn't. The step-up in basis is one of the most powerful breaks in the entire tax code, and it only works if you don't give the asset away before it's triggered. This video is for educational purposes only, not financial, tax, or legal advice. The rules described are federal. Figures are 2026 and illustrative. Estate and gift planning is deeply personal, and the right move depends on your full situation. Please talk to an estate attorney or a qualified advisor. Sometimes the biggest gift you can give isn't the asset. It's understanding the rule that comes with it. If this changed how you think about giving, subscribe. Every week we uncover one financial blind spot that can quietly cost families thousands, sometimes tens of thousands, of dollars, and send this to someone planning to help their kids. The most generous move might be the one nobody told them about.